we have very short-term memories. Clients have very short-term memories. We're going to get to the whys here in just a minute, but what we're trying to do is put some context around these numbers. It's not fun. It's a little painful, but it is normal.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here today with John Martfeld.
Good morning.
And Lee Mackey.
Good morning.
So today we're going to really spend the majority of our time talking about just recent market events. So the last few weeks, if you haven't noticed,
what's going on in the market?
Last few weeks have been volatile. Yesterday was a little bit of a washout. And so just a lot going on, right? A lot of political uncertainty for a lot of people. The market's reacting not only to the political situation, other stuff too. But yeah, so we're going to talk about that. So as we look at, I'm going to put out some numbers just real quick, kind of what the market's done year to date. So if you look at, now these are the ETFs that track the major indexes. So I've got like SPY, QQQ, IWM, and then the Dow Jones pulled up here. So that's the S&P 500, the NASDAQ 100, and the Russell 2000. So year to date, the Dow is down just 1%, 1.14%. Year to date, the S&P 500 is down a little over 4%, but then you've got the NASDAQ and the Russell 2000 down 7.5% and 9.1% year to date. If you look at just the last, 1 month, it's even worse, right? You've got the Russell down over 11.5%, the NASDAQ down 10% in just the last month or so, which is closer to kind of all-time highs. So some decent pullbacks there. And before we jump in and get some feedback from you guys, looking at some individual names too, there's some true true pullbacks with some individual names.
Big names. So
if you look at, Tesla year to date down 45%, Nvidia year to date down 20%. You've got Walmart down 10 year to date, Apple down 10. All of those year to date, not from all time highs. Those are close to all time highs, but those aren't from their all time highs. So we've got some real pullback. I think Nvidia's down like 30%.
And I think Walmart's down 17,
yeah,
18 from all time.
So there's been some true, nothing like catastrophic yet, but like a legitimate pullback in both the names, and then we're starting to see it in the major indexes as well.
I saw this morning from Trump's inauguration. A lot of people pegged that as kind of a big date in this year, January 20th. I think the NASDAQ's off 15, 17 from the inauguration. The Dow is down 3 from the inauguration, and the S&P's down about 6, 7 from the inauguration. So, the market's pretty much hit that high, in mid-January, and then have begun to slide. So.
And it's the dreaded tariff talks.
Well, so how big of, so if you look at, before we get into the specifics of what we think, kind of why it's happened, if you rewind 6 months, I've got the major indexes that I just talked about, right? Yep. S&P 500, NASDAQ 100, Russell 2000, and the Dow Jones. Over the last 6 months, only one of them is negative. The Russell 2000 slightly negative. The rest of them are positive 2 or 3% over the last 6 months. And so everything we're about to say about like, hey, the market's kind of sucked the last few weeks, like you zoom out just a little bit further and it's like, well, we're flat the last 6 months. So keep that in mind and kind of keep perspective. It's not to, limit or belittle kind of what is happening, but it's also like you do want in these moments to zoom out and see the bigger picture.
Well, and to just put a little bit more color into what you just said, if you go out a year, and again, we are long-term investors, so if you go out a year, your S&P's up 11, your Dow's up 10, your NASDAQ's still up 9. So not a bad 12-month period. Again,
the questions that the question's always like, well, but where do we go from here?
Yeah.
Right. That's like a snapshot in time of like, okay, we've seen a little bit of volatility, seen a pullback. It's definitely more of a bearish sentiment kind of now than there was just 3 to 6 months ago. But does this kind of remain as a very, very normal and what should be expected 5, 10, 15% kind of pullback and then recovery, or does this kind of continue? And that's everyone's kind of obviously current question. Because historically, here, go ahead. Let me pull up this chart. And then
5 to 10% pullback, and let's talk about the S&P. 5 to 10% pullbacks on average occur on average 3 times a year. So
right.
3 times a year, we have a 5 to 10% pullback. Once a year, we have a full-blown 20% correction.
Yeah.
Okay? We've gotten spoiled over the last several years that we have not averaged 3.
Yeah.
I think the average drawdown in an annual period is maybe 14%.
I think that's that's pretty good. I think that's right.
I think that's right.
Do you do your homework?
Well, every once in a while I'll pull something out right. We have very short-term memories.
Yeah.
Clients have very short-term memories. We're going to get to the whys here in just a minute, but what we're trying to do is put some context around these numbers. It's not fun. It's a little painful. But it is normal. But to Matt's point, I think the question everybody is asking is, if we had a crystal ball, we could kind of tell, are we about done? I mean, who knows?
So this is
but these are normal.
So this is the bar graph I was looking at. So this is going back to 1990. There have only been 3 years since 1990 that we haven't had at least one intra-year 5% pullback. There's been some years that we've had 2, 3, 4 of them. Right. And so it's actually a lot more. It's a lot less common to have a year where we don't see something like this.
I'm going to throw my little 2 cents.
This one feels like there's a little bit more to it.
Yeah.
That doesn't mean I think it's going to turn into a severe sell-off, but it does. I do think there is true sentiment has truly kind of shifted.
Yeah.
It's not just, hey, there's a little volatility, but overall people are still very bullish, and there's still people are kind of jittery right now, and there's just a big question mark out there.
I'm going to get a little deep on you guys. You guys ready? Okay, I'm going to talk about a couple things. Reagan took office from Carter, and everybody's euphoric the day after the election that Reagan won, and the market went up a dramatic amount in just one day. Trump gets elected, the market goes up about the same percentage in one day, the day after the election. But it took 2 years before the market actually started making money under Ronald Reagan, because all of his policies were good, everything he was trying to do was great, but it took time to unwind where we were at, right? All right, Trump takes over, and it's kind of the same story. I think the things he's doing are going to ultimately be very good for the economy. We're bringing back jobs. We're doing all these, you can talk about the tariffs, the negatives and the positives of tariffs. I find it that we've been kind of taken advantage of by the world for a long time, and these are kind of necessary, in my opinion. It's hard, but it's necessary, and it's going to create some angst on the market. Now, going to the market. Every model that you look at, the Shiller cap ratio model, the Buffett indicator, I don't care what model you look at, every model shows that we are overpriced on the market. Every model. We're overpriced. The market is overvalued. So if you look at that, what happens when the market's overvalued? It can go on for years overvalued, and then the value can catch up by earnings and so on. But most of the time when you get to those levels of overvalued, any little negative news can make the market just turn the corner, right? People are looking for reasons to sell when you've done so well for so long, and 2022 is a bad year, but if you go from 2009 through today, I mean, the market's just done phenomenal. And there's a point where there's definitely going to be a pullback, natural pullback, right? And when you get to these levels of overvalue, any type of news that is not perfect can send the market the other direction. And I think the uncertainty of the tariffs, the tariff policies and where they're going, because one day they're on, the next day they're off, the next day they're on, the next day they're off. I think that uncertainty creates fear. It's easy when you're overpriced
When you're
fear
priced to
starts,
perfection and perfection
Exactly.
doesn't follow, then
the selling can happen, and it
yeah.
can snowball. But long term, like we've talked about a million times, it's a long term market. You went back 6 months, and we're up on two of the three, or
three of the four. We're
Russell,
positive.
Yeah. So if you go a year from now, what are we going to look at, right? Are we going to say, starting today, a year from now, there's a good chance we're going to be positive in all these indexes, but there could be some rough times between now and then.
And I think these moments, not knowing how this current market kind of, where it goes from here over the next 3, 6, 12 months, I think these moments are really good reminders for investors. And I say investors, like myself included. This isn't just talking to the clients. I feel like advisors, we often kind of talk to the client. Like advisors are no different, right? We have the same thoughts, emotions as a lot of clients do. And these moments are good reminders that, investing is not as easy as some people make it sound. It can be emotional. It can be hard to stick with it. And if you want, higher than risk-free rates of return, it involves risk. And so like you have to have the downside and accept the downside to have the opportunity to get above the risk-free rate of return.
Yeah.
And long periods of time where we haven't really seen any downside or any volatility to speak of, you kind of start to take that for granted. And then you start to think, and we see this all the time, you start to think, well, maybe I'm okay being a little bit more aggressive than what I thought, right? And because you don't have that recent memory of like, man, losing 15, 20% didn't feel too good. And
the fear of missing out.
Yeah. And so these are good like reminders of like, okay, what is our true risk tolerance and how do we need to be allocated? Because, it's not always up and to the right. And another chart. So this is from Ritholtz Wealth, their guy that runs their charts. He puts out some really good stuff, but historically normal for large down days to happen, 1% down days in the S&P 500. This was as of the end of February. So, you go back here and look, we'll post these charts, but the average is 31 going back to 1990 of average 1% down days in a given year. At the end of February, we had 5 for this year, year to date.
Right.
2022, there were 63. Last year and the year before, in 2023, there were 28 down days of more than 1% in the S&P 500 and 19 in 2024. I would not have said that if you would have asked me like an over under 10% on that. So again, like some volatility is normal.
Let me tell you, going back to my Morgan Stanley days, I was there 2011 to 17. When I first got there, they would put out a 100-point letter. Anytime the market moved 100 points, they sent out a letter to the clients up or down. Okay,
they would have sent out 8 yesterday.
It began happening so often they changed it to a 1% letter.
Yeah.
Okay.
Right.
But so last year, just the down days would have been 60. What was it last year?
No, last year the 1% or more down days was 19.
19.
But that was in a year where the S&P was up. 63 was in 2022.
Okay. So the point is, sorry about that. The point is that as we've raised, 1% movements are common, now. We don't even blink oftentimes when it happens. So,
well, we were at, again, go back to 2009. We were at 6,400 on the Dow. We got all the way to 45,000 on the Dow. We've come back slightly from that, obviously. It seems like a massive amount we've come back because it's all happened in a couple of weeks. But percentage-wise, it's really, we're really close to the all-time highs. We're still really close to the all-time highs, even with these 10, 11% pullbacks or
one of the
more.
best things you can do in anytime there's volatility, anytime you start to get nervous, just pull up a chart and click on, and don't look at the year-to-date. Don't look at the last 6 months. Just click on, like, the 10-year.
Okay.
Right?
Yeah.
Because it's going to immediately be like, it's going to make the current moment look like a drop in the bucket, and it's going to put things into perspective.
Now, to caveat that, though, think about this for our clients. If you are in retirement age, it is more daunting to see these things happen. But also, if you do a proper retirement planning, you should not be exposed to all of this. You shouldn't You shouldn't
if
have
you
100%
don't need
of
to
your
be taking that much risk, then you shouldn't have that exposure.
Right. So if you need to take that much risk and you're in retirement, it's going to be a wild ride because if you
the good thing about the current environment is, bonds, we're not setting at 0%,
Correct.
yields. And so like fixed income has kind of done what you want it to do year to
recently.
date.
Yeah.
Like
yeah.
in the last couple months, market's been volatile, fixed income's been positive.
Yep.
While it's spitting off, still a decent yield, and like that's what you want it to do. So that makes our jobs a lot easier. We have more options.
Yeah. To put again a little bit more perspective on this, the S&P doubled in 4.5 years. You do the rule of 72,
Right.
Yeah.
That's some pretty hefty returns.
Yeah.
I mean, high teens.
Which is, again, if you go S&P's average historical return is under 11%. So we have outperformed the average return for a long time. That it does revert back. It doesn't go on that same track forever. So it's like expectations need to be tempered, I think. But also planning is so important. So the only people that lose in these markets are the ones that sell. But it is not easy to tell that to somebody who's got all their money at risk and they're watching it go down and they're close to retirement. That's why planning is so important, because our clients that are in those positions aren't fully exposed. So it's not, these numbers don't affect everybody.
And
but
you
if
have
you're
to- you have to
35,
know-
you could be exposed, but hang in there.
You have to know and accept too, and I get this. Like, I get this personally. Like, it's always going to feel better doing something. Like, so you're going to justify and talk yourself into doing something just because it feels like you should.
Right.
Right. So you've got to, and that's hard. It's really hard, especially if you're trying to do it by yourself or you don't have like an accountability person or someone helping you with your, how you're managing your portfolio. It's really, really hard because there's always like this sense of relief of like, okay, I took action. I just did something, and it may or may not be the right decision.
Again, here's my numbers coming out. Put it a little bit more into perspective. The NASDAQ has doubled in 2 years.
Yeah, that's nuts.
2 years.
Yeah.
Right.
I mean, January of 23, we're at 10,000.
So it's averaging 36%.
It's
in 2 years.
Matt, you bring up a great point, and it's something that I have shared with clients, for almost 30 years, in that sometimes the best action is no action. Mm-hmm. But to your point, they feel like they need to be doing something. We need to buy something, sell something, get out, because it makes them feel better at the moment. But, I mean, I've had countless conversations with people that'll say, well, you didn't do anything during, what are we doing? And I'm like, sometimes the best action is just staying put.
Well, we had this conversation internally yesterday, right, in our advisor meeting. There has to be reason and rationale for why you're doing what you're doing, because if there's not, then it can be, how are you going to stick with it through the difficult times, right? Because you're not going to have that like that source of truth or that point of, like to go back to and say, no, like this is still right. This is why we have this allocation. This is why we're doing this. And no, even though this is happening in the market, like this still remains true.
Yes.
If you don't have that, then you're just, you don't know. Like there's no true underlying rationale to why you're doing what you're doing. And so it's going to be really hard to stick with it.
And that's why our risk parameters, our risk profiles are so important, because if John, if you're a moderate investor, that's not, I'm a moderate investor only when the markets go up, but it's also a moderate investor when the markets go down, and reminding our clients. That's why, man, psychology is so important in this business. That to me is the important aspect of what we do. And
yeah, but think of moderate investor. If 60% of their money is exposed to the market and the market goes down 10% in a short amount of time, and say you have $100,000, you're down $6,000, right? 40% of your money is in bonds. Let's just use that simple math. And you're up 3% or whatever in the bonds in that time, or 2%, whatever. You're down 5,000 in a market that's down 11+%. Does that make sense? Like the whole point is, if you know what your number is and you're allocated correctly and you're you have a good financial plan, you're never going to take the full brunt of these big storms. Mm-hmm. And so it doesn't matter to most of our clients, right? Most of our clients are not fully exposed to this.
Okay, so to tie a bow on this, what's your S&P 500 year-end prediction? Price. I'm kidding. But like, where do we think this goes? So we've got the tariff situation, like knowing that we don't have a crystal ball, we don't know what's going to happen. Like any kind of final thoughts on just what the market does from here?
We really didn't touch on the whys. The why is there's so much uncertainty. There's not bad news. There's not good news. There's just a lot of we don't know.
Yeah.
And the markets hate uncertainty. And the tariffs on, off, recession, not recession. I mean, really what spooked the markets yesterday was not necessarily tariffs. It was the comments made by the Atlanta Fed and by Trump's lack of pushback when asked about a potential recession. You used the term at the very beginning, washout. In the investment business, we look for a washout day, a capitulation where literally you're throwing the baby out with the bathwater.
Yesterday I had a little bit of that feel.
A little bit.
It wasn't like hit you in the face, obvious, but it just felt.
Honestly, as bad as it may sound, I wish we wouldn't have sold. I mean, I wish we wouldn't have kind of rallied a little bit into the close. I wish we had just had that complete.
Like a true.
Honestly, this morning, a good washout would have been everybody called their broker overnight and said, get me out at the open, and we opened down 1,000 points. That would tell me, okay, we've just cleaned it out. We may not have that, but I'd like to see that a little bit before we really begin to make some legs up. But my prediction, I still think we come out of this okay. We just need to clean up. We just need some clearer pictures on tariffs and things like that.
I think GDP is going to be negative in the first quarter. I think and that's going to signal that we're on the way to a recession. Whether we get through a recession or not, who knows, because you have to have multiple quarters of negative GDP to, stamp a recession. But I think you're going to see fear when those numbers come out in April. Again, I don't think we're done with potential selling. But I also think you're going to have opportunity buying that's going to get the market back up a little bit, and then you're going to sell.
Because the market's going to probably trade ahead of that, right?
Yeah.
Like by the time we know, this was official recession, like the market's going to have, not saying the market could move lower from there, but the market's going to have a good portion of that priced in at that point.
It is. And think about recessions. If you go back to the big, massive recession we had in 2008, the recession was not stamped a recession until well into that downfall. Mm-hmm. And we did not stamp ourselves out of the recession until well after we had stormed back. And I think that's the misconception too. Everybody hears the word recession, you think everything's going to be, we have to get out before the recession hits or whatever. But in reality, we're suffering the selling right now, and the recession has not been stamped. Whether we get a recession or not, the selling is done. By the time the recession actually is stamped a recession, then you start seeing buying happen, which is amazing. It's not necessarily determined.
The stock markets are 6 to 9 month leading indicator.
Yeah,
so just keep that in mind. The thing that does trouble me a little bit is, retailers are not positive. Yeah. I mean, across the board. Walmart's a little bit of an exception, but of course they thrive in a recession. But retailers across the board are painting the picture of this is not going to end well.
Well, all these problems we've talked about the last year that I've been the pessimist in here, credit card debt is all-time high in our country. When credit card debt gets to the all-time high, eventually people run out of credit. Mm-hmm. My point is, spending does slow down when you have that type of economy. We have an economy where we've borrowed a lot of money. So we went from over savings when Trump left office to the highest credit card debt we've ever had when Biden left office. Yeah. Now, that is a massive change in the economic condition. And that does lead to retail. It does lead to, it's kind of, and simply put, there's not enough dollars to buy things that there were 4 years ago. But that will change if we get some of these other, if we get some things worked out. So I'm not worried long term, but I do see these things coming to fruition.
The positive is we've kind of got, and I'm not saying I want these to happen or that I think they should play these cards, but we kind of have two puts that could be played, right? You've got I heard this on another podcast. You've got the White House put, right? Not that this would solve everything, but the market would have less pressure, feel less pressure if Trump came out tomorrow and said, hey, we're pausing all tariffs. We're going to sit down at the negotiating table with these countries, like tables off the board for the foreseeable future.
Yeah.
Right? So they're like, there's always that card that could be played that could take some pressure off. And then you're back to kind of having the Fed put, right? The Fed could start to cut rates because rates aren't at zero. They've got some ammunition finally, which is a good thing. It's positive. That's why they needed to get rates up. As part of the reason, so that if we get into a tighter spot, like they can help. They've got some cards they can play. So keeping those things in mind, like we're not sitting in this spot where there's not levers that could be pulled, not trying to avoid something, but maybe just kind of help us ride through it a little bit.
Well, it's not just Trump that the tariffs. So think about the tariffs. All these other countries are in worse shape than the U.S. based on these tariffs. In other words, he's going to force them to come to the table and make better deals with America, which will help everybody in America.
And I agree.
Help America.
I'm not saying I agree. I'm not saying that he should.
No, I know. But I think that you're right. I think that some of these tariffs could be taken away because they come to the table to negotiate, and it's better for us in the end. And I like that.
A couple good notes. One, 10-year bond has dropped. Mortgage demand has gone through the roof.
Which
is
great.
That's a little bit of good news.
That's great news.
The one thing that's interesting, the Fed odds have increased to 3 from 1.
Good.
But it's interesting. There's some thought that the Fed may sit on the sidelines a little longer because nature, the economy has brought that 10-year down on its own.
Yes.
But
it took it up.
Absolutely.
Exactly, which had nothing to do with
it. Chairman Powell's pretty smart. People don't need to knock him all the time. But
hey, you know what was funny? It was a reminder that I have little kids. Because when you said the market hates nothing less than uncertainty, the first thought that went through my mind was, we don't say the word hate.
I'm sorry.
Is that not? Yeah. I was like, man,
the market doesn't like.
This is a sad spot to be in life.
Mom, he said the H word.
So well,
sorry, Haley.
If you guys have any questions, any thoughts, let us know. A lot going on in the market today. We just wanted to kind of get on here and talk through some of it, give you our thoughts and opinions on what's going on and why. So we appreciate you guys listening. Give us a like, subscribe, comment, and we will see you guys next week.
Have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.